Well, to say it's been a crazy week is an understatement. Here's a little backstory on how things transpired last week and the eventual collapse of Silicon Valley Bank, SVB, and Signature Bank. On Wednesday, the 2-year Treasury hit its highest rate since before the Great Financial Crisis all the way back in 2008. Silicon Valley Bank announced on Wednesday it had been liquidating securities and was engaging in an equity issuance on Friday. They saw massive outflows on Thursday and Friday, and over $40 billion worth of deposits left, and Twitter was a big reason. Twitter had helped cause a bank run. You see, Silicon Valley Bank was primarily made up of venture capital funding for startup tech firms, creating the perfect storm for Twitter to spread the concern like wildfire. Fast forward to Friday, the Federal Reserve, FDIC, stepped in and essentially shut down SVB. This in return put a lot of pressure on regional banks. Fast forward to Saturday, and the FDIC came in, and they shut down Signature Bank as well, based in New York City, and took over control there, causing the second and third largest bank collapses in U.S. history. SVB had approximately $200 billion in assets, while Signature Bank had approximately $110 billion in assets. On Sunday, I think it was Sunday, the FDIC made a special provision that all depositors would be made whole by guaranteeing all deposits, even above and beyond the $250K insurance limit for both SVB and Signature Bank. So what the heck happened? Two things really contributed to the collapse of Signature Valley Bank. First was their deposit base was not broad. They were not diversified. You've heard that word before. It was not a broad mix of customers. They were too concentrated with well-funded tech startup companies from VC firms. 86% of the deposits were above the $250,000 FDIC insurance limit. This made them vulnerable to bank runs, hence some hysterical tweets on Twitter, and there you go, over $40 billion out the doors on Thursday and Friday. Signature Bank had the same problem, with almost 100% of deposit accounts above the $250,000 limit. Second is really where the stuff starts to hit the fan. They did not manage their duration risk properly, SVB. What does that mean? It means they essentially went too long out on the yield curve and took too much risk trying to maximize yield. They bought a whole pile of government bonds, mainly long-term 30-year treasuries, because the Fed kept interest rates at very low levels, at abnormally low levels. You've heard me say that before. They forced an asset bubble in the bond market. Since the Fed had to start aggressively raising rates over the past year or so, creating bond prices to plunge and yields through the roof, especially short-term yields, the value of their long-term government bond holdings were getting killed. Fast forward to Thursday and Friday, when they had their $40 billion bank run, they needed to sell those long-term government bonds. Oh, by the way, for a tremendous loss of $1.8 billion. That was it. They were done. Signature Bank had very similar issues. However, many of their issues seemed from being too heavily concentrated with cryptocurrencies and the Bitcoin and the price of that from a year or so ago. There's an old saying that the Fed keeps raising rates until it breaks something. Well, it may have broken the regional banking industry. The real question is, will the Fed continue with its plan of aggressively raising rates to combat inflation? Inflation numbers came in a little bit better at 6% from the month before at 6.4, but still, many experts surmise that with the banking issues, especially for the regional banks, they would not do anything. Not so fast, though. However, since the European Central Bank raised interest rates by 0.5%, many think this will give the Fed the ammunition it needs to raise rates by 0.25%. Because there's all issues going on there with Credit Suisse. So what does that mean for our investments, our investment portfolios? At the beginning of the week, I really strongly felt that the Fed was probably going to sit tight and not raise rates at all. There was very strong indications that they were going to do a 25 to 50 basis point rate increase. So fast forward to the beginning of the week, everything I was reading and what would make sense to me was that they would not do anything, because by raising interest rates, they're essentially playing two sides of the coin. One side of the coin is they have to worry about inflation. Inflation is still extremely high. Yeah, it's not 9.6% or whatever the high number was, but it's still 6%, which is way off from the 2% number that they want to get down to. But by raising interest rates, you're putting more pressure on the regional banks, because what happened with SVB Signature Valley Bank, is essentially that. The interest rates, the yields on the long-term treasuries that they owned went through the roof, which means they have an inverse relationship. When bond prices go up, yields come down. When yields go up, bond prices come down. So all of their holdings in bonds, their long-term holdings in bonds, which is what most banks and insurance companies, financial institutions do, they hold them until maturity. What they didn't plan for was a $40 billion bank run on Thursday and Friday. So they had this $40 billion bank run. They had to then go sell long-term treasuries that they had bought to hold until maturity. But since the Fed started aggressively raising interest rates to combat inflation, their bond prices tanked. So when they sold, I think, about $30 billion worth of bonds, they realized a $1.8 billion loss. They were done, as we just went over. But the reason I bring that up again is the Fed. If the Fed raises rates, which then causes bond prices to drop and yields to start to spike up again, the 2-year yield hit over 5%. It's down in around the 4% range. If the Fed raises rates, well, now they're putting more pressure on the regional banks because yields have plummeted and bond prices have gone up. It's given regional banks it's given them a lot of relief on their balance sheets because their bond prices have gone up, so their capital looks much better. So what will the Fed do? I don't know. What that means about our investments, typically the way our investments are set up and what we do is we're in good quality stuff built to meet the objectives of your financial plan, your financial goals. And we don't really ever make, rash decisions on crazy things going on in the market because we're set up with a stock to bond to cash mix, that warrants what we're doing. So as of now, we're not really going to do much of anything. Today the market kind of seesawed. I'm recording this on Thursday. And this will be out to you guys tomorrow on Friday. So the market's kind of seesawed back and forth. Credit Suisse got a whole bunch of money coming into the market. So the long and short of it is, if the Fed does not raise rates next week, is that good or bad? Well, if you would think if they don't raise rates, that means that, interest rates, bond prices will kind of start to rally back up again, and there'll be a more influx of money coming into the market. And you would think the market and the growth side of it would kind of take off. But a lot of times, good things are bad things and bad things are good things when you're talking about investing, because if they do not raise rates, does that signal to people that the banking industry is in such disarray that there's a lot more issues than they want to lead on to, because we know that the Fed wants to aggressively fight inflation. So that's where we stand right now. Stay tuned. If you have any questions or concerns, of course, please reach out to me. Also, right below in the weekly Friday chat email, I did another video and a tutorial on a really cool tool and kind of going over how the FDIC insurance limits works, registrations. So have a great day. Remember, eat some pizza. Friday nights, pizza nights. See you later.